Okay, hello everyone, it's Michael Valtos here, and this is the second video on the indicators that I'm doing. This one is on the Valtos Flip order flow indicator, and again, I'm creating this video to sort of go more in depth and give you more in-depth knowledge of how to use the indicator and how to get the maximum benefit out of it. Because like I said, people were getting this indicator and just using it as the basic default settings and not even trying to explore how to use it and then saying it's not working. But it's actually a very effective indicator if you take the time to understand that each market is different. You can't use the same settings that you would on a E-mini chart that you would use on a Euro currency chart or a bond chart against a crude chart. Each market has different volume and different participants, so it trades in general it's the same but slightly different. Volumes are different. When you're trying to analyze volume, you can't use the same volume settings for a very liquid market as you would for a thinner traded market. But before I jump in, a brief disclaimer: this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. The CFTC rules 4.41, hypothetical or simulated performance results have certain limitations. Unlike actual performance records, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. And at the end of this, the later part of this presentation, I'm going to take you through the month of January for many contracts, so you can see how effective this indicator really is. I said it bothers me that some traders just want everything red light, green light, without one, understanding why there's a red light or green light, and two, without understanding that each market is different, right? You can't use the same settings. People were getting this indicator. There's a default setting, it's an indicator, so you have to have a basic setting, and they're just using the setting that was there. I don't know if they didn't read the instructions or what. Maybe they're very eager, but I include a short trading guide that goes with it, and it explains some of the reasons why you have to change the settings. But people would try it, and literally an hour later saying, oh, this is the worst thing ever, how could you put that out? Well, then I jump into why is what chart you're looking at, what's your settings. Then it's it's basically they're not using good effective settings for for whatever market or whatever time frame they're trading. I'm trying to think of how to put it in real life terms, but again, the basic thing is each market trades differently in the sense of volume, right? I said if you're using an indicator that measures traded volume, you can't use the same settings as you would for a very highly liquid market like the E-minis that you would for a thinner traded market as the mini Dow. You just can't. It'll really give you bad readings, for one market, and give you too many readings for the other market. So anyway, let's put this short presentation together. It's not short; it's probably about an hour. But I just want to go over the background of how the indicator started, why I came up with the indicator, and what it does, and sort of get down to the basics. Why do many traders fail? Well, they fail because they break the most important rule of trading: keep your losses small and let your winners run. What that means is to take small losses and take the big winners. But what ultimately happens is traders take the small winners and take big losing trades. That's the opposite of what they're supposed to be doing. So how to do it correctly? Well, you have to know when you're wrong. If you can't tell when you're wrong in the market, then you're not going to have small losses. I hate to say it's fine to have small losses. Again, nobody wants to have losses, but that's part of trading. Sometimes you're just wrong. Sometimes, you get a reading and it's wrong. Sometimes there's somebody on the other side of, I'll say the other side of you, but there's someone else sitting in another office somewhere that's got to do the opposite of what you just did. You can't predict that. There's a certain unpredictability in the market. And, the flip indicator, this indicator was designed to pick up immediate changes in market direction based on a big buyer or seller dominating the bar that you're in. And by dominating, what do I mean? I mean, in near total control. And, there are instances where in a bar, nearly all the volume, 95%, even in some cases, 99.8% of the volume is traded on one side, either the offer side, meaning a big buyer with very little aggressive selling activity, meaning, all the buying is aggressive buying, and there's nothing being traded on the other side, on the bid side, there's no sellers. And when that happens, sometimes it's very fast, that bar closes extremely fast. And the same is true for the other side. When 95% or more of the volume traded on the bid side, that means you have aggressive sellers. You have somebody coming into the market just hitting every bid. Okay, and again, it's hard to tell that. I mean, well, it's not hard to tell. You can't see it on a normal bar chart. A normal bar chart is just going to give you, the open, high, low, and close. And if you're looking at an order flow chart, yeah, you can pick it up by looking at the volume footprint. But, not everybody understands what they're looking at on a volume footprint. That's one of the reasons why I created these indicators. It's some of these things, people take my concepts and, try to repackage them, call them algo this, algo that, when it's just, a tool to help you read the order flow. Again, this is not a holy grail trading system. If you think it is, you just, flip off this video right now, because, it's not. At the end of the day, trading comes down to making the decisions yourself. Everyone, the big move nowadays, just reading the paper this morning and last couple of days, there's some guys out in Silicon Valley, they're trying to create a AI hedge fund, artificial intelligence, like it's some new thing, but artificial intelligence, has been around in the trading. I remember I bought a software on artificial intelligence back in the 90s. I never got it to, work meaningfully for me. But, it's not like some new thing that's coming. Everyone talks about, I got all these self-driving cars. And it's great. Is it? I like the fact that, some of these cars can self-park in a tight parking space. Yeah, that's nice. I do stress, though, sometimes watching how they try and park. But, I always take, when I read those articles about these self-driving cars, having very little accidents. Well, it's not the accident that they're in. I wonder, they should do a study on how many accidents are caused by self-driving cars, meaning the self-driving car itself didn't get into the accident, but the cars behind it are the ones that crashed. You see them on the movies, the girl's driving, she just got a driver's license, she thinks she's a great driver, and she's swerving in and out. She's not getting into the accident, but all the cars behind her are piling up, and everybody is cursing and swearing. So it's one of those things where it's, is it the new thing in the market? No, I mean, it's a new buzzword, AI. I'll say it's not even new, but, people try and come up with, new ways to analyze the market. But at the end of the day, it's traders that are making the decisions. And, this indicator is based on my own trading experience, because I've sat in a bank, I've sat at, a large commodity trading firm where you're moving size, and sometimes you got to move an enormous amount of size and in a very short time. And, what you're going to be doing sometimes is going to be sweeping the market. People talk about flipping. Oh, you sell 1,000 to buy 10,000. You try and push it down. The reality of that is, it sounds good in theory. There's only a few people out there that really do it because, one, you got to be very highly capitalized. And two, it sort of borders on, I'll say, illegal activity. I mean, spoofing is illegal activity. Flipping, I don't think yet really makes that threshold, because, you are trading in the market. Spoofing is just showing your intent, but flipping, you are trading one direction, then you turn around and flipping it. The exchanges don't like it when you buy and sell to yourself. But sweeping, is more indication of a market that's moving very fast. And what sweeping is a trader comes in and say, hey, I need to buy 5,000 E-minis, what's in the book, and they just buy everything, or the next 3 or 4 price levels. If they can get everything done, they're just sweeping everything in the order book. And it's very important because it signals that there's either quick accumulation or quick distribution. Sometimes these big hedge funds that trading in notional amounts, $100 million, $200 million, they'll say, okay, they'll tell their trader, they'll get the PM, the portfolio manager, will say, hey, I want to buy, $200 million worth of E-minis, and he'll give it to the trader, and the trader will just, execute it as best he can. And sometimes that means just sweeping the market and getting it done, and because they want to get it done really quick. And this is what this indicator does. It picks up on that. Is it 100% accurate? No, nothing is when it comes to trading. I wish that I could devise a method that would give me 100% winners, but there's nothing in this world that's 100%, ever. So get that out of your mind, that you can have something that's high percentage, but it's not going to be 100%. At the end of the day, the market's made up of human emotions and perceptions of value. Everyone talks about how computers and algos are affecting the market, but what? At the end of the day, it's individual traders that are doing making the ultimate decisions to buy and sell at the big macro hedge funds, at the big commodity trading firms, and it's based off of supply and demand that drives the market. Now, computer algos may be good at picking up, these little crumbs of, this one's mispriced by a tick or two, and come in and swoop it up. Okay, that's all well and good, but those aren't where trends develop from. That's just picking up the little ARB opportunities. And what you want to be getting, going back to the first slide, is having small losses and letting your winners run. Is you want to be getting in when the trends are starting, right? Not when there's a little ARB opportunity in the market, because you're not concerned with those little ARB opportunities. You want to be getting in when there's a trend about to start or a trend is ending. At the end of the day, it's markets move based on traders' perceptions of the market now versus where it's going to be in the future, and people tend to get lost in that. Actually, they tend to forget it and just try and let the market, let the trading system, via whatever method they're using, try and pick it up rather than understand why the market's moving. More than anything else, if you understand why the market's moving, why the market's reacting at a certain price, then it'll put you so far ahead of the rest of the traders out there that are using mathematical formulas over the last 50 bars and trying to determine that, well, where we are now is far from where we were 40 bars ago. That's a bit of a stretch. If you're trading lower than where you were 40 bars ago, that's good. It's good to know, but wouldn't you rather know about 35 bars ago, that the market's heading lower? And that's the difference of what order flow gives you. It basically gives you that advantage of knowing what's happening right now, and take advantage of it. So what's so good about the flip? Well, it signals an area where there's strong buyers or sellers. By strong, I mean total control, and that often occurs before a big move. When, like I said, understanding how trends start. Trends start because of long-term traders coming into the market. They have a view and they start accumulating a position, or if it's at a high, they start distributing a position. If maybe they have a position on and they start dumping it, or they think it's very overpriced and they start selling it. So there's a lot of reasons why it can occur. It could be an important level, it could be a new position being established, could be taking profits. There's a lot of reasons, and I'm not going to get into them right now, but because I don't think it's that important. But what's important is being able to pick it up and understand that there's a shift in the market. Now, there'll be times with this indicator that you get a signal in direction, then immediately an opposite signal. And like what I mean immediately, like either the next bar or the bar after. Don't be discouraged by that, because sometimes, market moves in one direction really quick and snaps back immediately as the algos notice that it's out of whack and kick in. Like I said, there's these algos just sitting there, waiting for the market to be what they think mispriced by a tick or two, and just come in and put it back in line. That's what these algos really do. And honestly, if you think you're going to compete with algos, you're not competing with algos, because they're 1,000 times faster than the human, and then they know what to do. Whereas if you're trading by yourself, sitting there clicking, point and click, you're not gonna beat them. They're sitting on these servers, just right next to the CME server, and you can't. It's impossible. Just back in before people realized that. I say before it became really known, there were these prop trading firms. They realized that being in the same building, the Board of Trade building where the Board of Trade servers were, put them at an advantage. This is before all this electronic trading really, took off with people, basically programming black boxes. These were traders that were just point and clicking. They realized they were faster being in the Board of Trade building where the servers were than someone, 2 blocks away in another building. So, now it's at the point where, you could rent server space. The exchange knows that it's an advantage, and they charge up the wazoo for, being able to place your server there. I mean, for you can get a server with, a server hosting company, not at a relatively inexpensive. By relatively inexpensive, I mean like $100 a month. That's quick. But I mean, if you're a hedge fund and you want to do it, your own server, it's going to cost you a lot of money. But anyway, and so there's going to be times where you get a signal in one direction, then immediately you get another one. Like here, this is a buy, then it comes back with a sell. Here's a buy and it comes back with a sell real quick, and then another buy real quick. Sometimes it happens, when a market is in a range, and sometimes it happens like this. The market's sold off really quick. You get a buy signal. But then, the sellers come back in and say, hey, this is, we're going lower, and whack it lower. I mean, don't be discouraged by that. It's about taking small loss. Like, going back to the first slide, take small losses and let your winners run. If here you could take a small loss, 1, 2, 3 small losses, even here 4, okay? But then you get the nice move down here. That's what you want, right? It's being able to recognize you're wrong. How do you recognize you're wrong? Well, if you violate, where your entry is, right? If it comes down against you really quick, really fast. I mean, you could maybe later I'll talk about where you should be placing your stops to get out. But I will when I go through the examples. So again, if you're trading U.S. products, trade during the U.S. trading hours, 7 a.m. to 3 p.m. when there's the most volume. And outside those times, less volume, and the underlying cash markets are closed, so the moves are based on what other markets are doing. So if you're trading E-minis at midnight, you're trading based off of what's happening in Japan, and you don't know what's going on in Japan if you're sitting in your trading room in your house at midnight. And again, not every market trades the same way. The flip indicator deals with delta, which is, the difference between the volume traded on the bid, the volume traded on the offer. And each market has its own way of trading. The 5 years, the ZF, just slopes along. It's a slow moving contract. Some traders are happy to get 5 or 6 ticks because they can trade size in that market very easily. I know some guys that just try and get 1 or 2 ticks that are very happy because they trade 1,000, not 1,000, 100 lots, and 100 lots, and they're done for the day. Okay. Euro currency can be more volatile, and you get moves 20 ticks and up. And the biggest problems traders make is they treat each market the same. Again, don't use the default settings of the indicator. I'm going to go through settings that you can use, because if you use the default settings, it's such a general setting. On some markets it will, but the majority of the markets, it won't work effectively. And you have to approach each market differently, because, if you're trading a 3-range S&P chart, it's going to have a general setting that's going to be different than, say, a 10-minute NQ chart, okay? Or a 1-minute E-mini chart. You're going to look at differently than you would a 1-minute mini Dow chart. Unfortunately, many traders have been doing with these indicators is being let down. And when I say that, I mean, I'm talking about using the default settings. That they think it's a done for you setting. It's not, okay? It's a default setting, because you have to have a default setting in there. And if you're just loading the indicator on your chart with the default setting, it's probably not going to look very nice, okay? I wish I could go in and, maybe in a future edition, go in and change different settings, but it's like, I don't even know how to put it in real life terms. But, keep in mind, when you're dealing with delta and volume and order flow, you have to take into context the market you're trading. It's not a one-size-fit-all indicator in the sense that the settings you use for one market will be the same for every other market. No, it won't. Keep the market in context. Now, keep the market in context is also leads into this next thing I want to talk about is times to trade. I can't stress this enough. People, I don't know if they don't listen or just don't care, damn the torpedoes. I'm going to trade no matter what, whenever I get a signal. Okay. Well, you got to be careful. I'm not a big fan of trading around data releases or announcements. For example, the unemployment number first Friday of every month, or a Fed announcement. What happens when you have these times is volume dries up and you get quick moves back and forth in one direction, literally in seconds. And sometimes it's in the same second you get 10 bars and you get a big move within 2 seconds. And the result is you get chopped up or you get your head cut off if you're on the wrong side of the market. If it just moves in one direction very fast. I mean, why take that chance? Okay. It's like, you think, well, it's cold outside. I could walk across this frozen lake. Well, you don't know how thick the ice is. Well, it's cold. You see there's a layer of ice. Do you want to take the risk? No. You're going to wait till it gets colder and the lake freezes more. And it's like the same with trading. Wait for the market to settle down. For example, here you have, this is the euro currency. This is on last month's, January's non-farm payrolls, 7:30. This time here, from this bar all the way to, this bar, this is 7:30. This is the 1 minute. And you can see this is an 8-range chart, and it's moving all over the place. You get sell, buy, sell, buy, sell. I mean, yeah, even though you get some small owners, you can't react fast enough. By the time you think you get this buy here, you buy it, it's already trading down here, and then you should probably be short. But, just sit it out. I mean, there's nobody's holding a gun to your head saying, hey, you have to trade at this time when the number comes out. No, I learned very early on in my career when I was on the trading floor, and we'd have this Fed announcement. This was back in the 90s when the Fed started raising rates. And, it was quite regularly, actually. And you would just look, at the dealers, around the trading pit, when, the Fed makes an announcement, who's active. It was all the retail traders out there. People that know what's going on and, thinking how this is going to affect their portfolio. Everyone's going in every direction. It's the professional traders, the ARB guys, even the ones, the institutional phone banks, at these companies, because, each brokerage company, they would have a retail desk and an institutional desk. The institutional desk would just be quiet. Their big customers were just, sitting it out and waiting and watching, waiting for the market to settle down before jumping back in. And, so that's one of the reasons why you get these big movements is because the liquidity just isn't there. The big players aren't there. And, even these hedge funds, when the numbers come out, when these big numbers come out or announcements, they have instructions with the trading desk, pull my stop out of the market. And, if it gets there, call me, but don't just start executing it, because if the market spikes up on very thin volume, they don't want to be stopped out of the market. They want to reassess it. That's what they're paid millions of dollars to do, is assess the market, not just, take things blindly. So, wait for the market to settle down. Don't necessarily just jump in because, it's, got a lot of signals here and, this one worked, this one didn't work, that one didn't work. This is the worst thing ever. take it in context of the market. If the market is got a period of no volume because the non-farm payroll number came out, which is the biggest number for the market each month, why are you trading at that time? I mean, you shouldn't be. If anything, you just be sort of sitting back, sipping a glass of water, waiting for the market to settle down. And it does. This is later, 7:40. Okay, I'm not saying 7:40. Usually, me personally, I give it about 15 minutes, but this is 7:42-ish, 7:42 and a half. You get a nice trend. Now the trends are going to start to develop. Then later, 9 o'clock, you get a nice little move here. It comes back up. People say, "Well, it came back up. I got stopped out up here." It was in your favor all this time. You should have done something, taken some money off the table. Nevertheless, again, a little bit later, 9:30, you get another buy. And the market makes a nice move higher. Okay, so settings. All right. Most important thing, do not use the default settings thinking that's all you need. No. Especially if you don't understand what's going into the settings. If you're using the default settings without understanding what you're looking at, then you're just going to be lost. I mean, it's like having a map but not knowing how to read a map. My wife doesn't know how to read a map for some reason. I don't know why. It's just, I never learned in school. Well, don't you want to learn? She'll complain when I'm driving and I get lost and I ask her to look at a map. It's my fault that we're lost, but okay, let's look at a map and try to figure out where we are. I don't know how to read a map. Well, if you don't know how to read a map, then you'll never get to where you're going, right? And if you don't understand the settings and you're just going to use whatever default settings, it'll be like, I got GPS in my car, but lots of times the GPS is wrong because, it hasn't been updated in a couple of years, I think. Now some roads are closed and whatnot. But if you're using, the default settings, you're going to run into those, those closed roads on the GPS. So, I'm giving you these settings, in less liquid markets, like Euro currency, mini Dow, NASDAQ, mini NASDAQ, minute charts, range charts, you go with 1 in 25. I'm going to explain what the 1 in 25 mean. In the more liquid markets, go with 1 in 250, ES, 5 years. Somebody asked me what this was, 5 years. I should change that. I'm going to put it to ZF. ZF is the electronic symbol for 5 years. FV is the old floor code for 5 years. When these markets went electronic, they had to differentiate the electronic contracts for the quote systems from the floor. And so all the electronic contracts ended up with a Z in front at the Board of Trade. Mini Dow, YM, was just strictly electronic, I believe. But like ZB for bonds, ZC for corn. On the floor, corn was just C. Soybean, ZS. That's how they differentiated them. Now everything's electronic, so they just keep the symbols. But when the markets were side by side, trading side by side, then because there's people sitting outside the pit watching the quotes on the screen, and versus what's happening in the pit, so they needed to just have the quote feed for the electronics, and that's how it was differentiated. So again, it shows my age a little bit, but if you see me say like FV, that's the old floor symbol for legacy is the old legacy term for 5 years. That's why if you look at some of these books written before the 90s on trading, sometimes you'll see these codes that FV or TY or US for bonds. But anyway, that's where it came from. But again, don't use the default settings on the indicator thinking that's all you need. Now settings, when I say 1 in 25, what I mean is this area here. There's flip A, there's flip B. I treat them the same. And why there's flip A, why there's flip B is because there's, sometimes there could be a bar or two in between that, you can sort of, I don't say disregard, but, sometimes it just doesn't happen back to back. Sometimes it rests for a bar or two. That's the difference between flip A and flip A is immediately, flip bar is, if it reads it over the next couple of bars. But anyway, you could enable, if you just want to look at flip A, keep it true, and flip B you'd change to false so it wouldn't read flip B. But I like them both. I treat them exactly the same as far as trading. Intensity 1, intensity 2, keep them 1 and 1, 25 and 25. That's for settings of 1 and 25, and flip B would be the exact same. Now under the plots, Now you can change this, okay? To differentiate between a flip A and a flip B is, you can go and change the colors if you want, but the way I differentiate it is between the size of the triangle. It's triangle up, triangle down. Again, you could change it to whatever you want in there, but I tend to keep the first one smaller than the second one. I mean, that's just a personal thing. If you can always change it to whatever you like. Okay, so for more liquid markets, E-minis, 5 years, 10 years, go with, start at 1 in 25, or sorry, 1 in 250 rather. So, 1 and 250, 1 and 250. So 1, 1, 250, 250, 1, 1, 250, 250. Okay, so adjustments you can make to these settings. The intensity. Okay, the intensity, the smaller number is stronger. So by having an intensity of 1, that's about as strong as you can get. I don't want to use 0 as the strongest. Actually, I haven't tested it as 0, but if 1 is about as strong as you get. Sometimes, with these NinjaTrader, you put a value of 0 and it just doesn't work properly for some reason. But anyway, 1 is the strongest you could get. But as you get higher, the number, the intensity gets weaker. So if you change the intensity, that's this one here, intensity 1, intensity 2 to 5, say you change it to 5, it's going to get weaker. And what that means is you're lowering the threshold. So instead of, it'd be like having I don't know how to say, a hole, right? 1 would be, the smallest hole you could have. 5 would be a little bit bigger. So, if you're draining water through that hole, if it's a 1, it's going to be letting very little water through. 5, 10, 15, it's getting bigger. A lot more water is going to come rushing in. Delta, which is this next number, delta 1, delta 2, measures the minimum thresholds for delta that it uses to do its calculations. Thinner markets that don't put in bigger deltas in the bar use values that are smaller. I like 25. It's borderline. Again, I don't like to split hairs, and say, it's got to be 25. If a market, you could use 50, you could use 35, find a level that you're comfortable with. I tend to try and keep, I tend to group markets, whether liquid, thin by liquidity, thin, medium, large. And, the thinner markets I tend to keep around 25. The thicker medium markets, maybe around 100, maybe 75. Sometimes I go back and forth, and, I don't want to like optimize it to one thing, but, I do think there's a sweet spot for many of these, but I try to have, in general, when I group these markets into thin, medium, and large, for medium, I'd probably put in crude oil. I don't trade a lot of these other commodities anymore, so I'm not up to speed on them. Crude oil, I jump between, anywhere between 75 and 100. Bonds, I don't use this on bonds actually, because I got other things I like with bonds as well. But bonds, I would probably use the same as 5 years. I would try 200 actually. Again, there's not a big difference between 200 and say 250, but there's a big difference between 25 and 50. On a thinner market. On a thicker market, again, 200 to 250 is not much because you're trading a lot more volume. But on a thinner market, it can make a big difference. So experiment. Try it. See what you're comfortable with. Now, if you're going to change the setting to say 5 and 250, 5 would be the intensity, 250 would be here. You could change it to 5 and 500. Sometimes I look at charts with 5 and 500 to see, if things, if the markets are really starting to pick up or not, and you're starting to put in more liquidity. So, I'm going to go through a bunch of charts. Again, this is for the month of, basically the month of January and the first week of February, because, I want you to see it in action, right? I want you to see the good, the bad, the ugly, basically. I don't want to sit here and put up charts, it's just a screenshot of a chart and say, oh, yeah, he only is putting up the pretty charts, where it's working, not showing the charts where it's not working. So, I'm going to jump in here with these different charts. So give me a sec. All right, so this is the first chart. This is a Euro currency 1 minute chart. Again, the setting is 1 and 25. Again, try to keep it during the U.S. trading hours, preferably. I mean, yeah, Euro currency does put in decent volume starting around 3 a.m., 4 a.m. But, if you're in the U.S., trade U.S. products during the U.S. hours. If you're in Europe, trade the European, trade Bunds. Bunds is a great contract to trade. DAX is decent. Euro stocks can be very slow sometimes. But there's contracts, in every time zone, the major contracts in each time zone. In Asia, it'd be Nikkei. So let's take a look here. So starting on the 4th, what do you got? You got to buy here, a little bit up. Sell, failed. Buy, going into the close. So, you got one decent one. Then the next day, well, this is the 3rd, so the next day is the 4th. And, what do you got? You got to buy very early. Okay, you probably might not be trading there at 6 in the morning. This chart start at 6 in the morning, go to 3 p.m. All these charts. There's some days where I don't have the data because for whatever, did some running around in the month of January. So, I wasn't trading, so I didn't have my charts open. So, then you get this nice buy here, and it's all day up. You get a sell followed by a quick buy. Okay, so the sell stopped, sell didn't work, but you got the buy coming back. There's a couple buys there that didn't work. You run into a bit of volatility, but you get the buy signal right before it takes off, but it did push lower. These, 2 o'clock. 2 o'clock is when the currencies close on the pit, when there was a pit. So, in all honesty, after 2 p.m., liquidity really dries up. So, be careful if you're trading after 2 p.m. Okay, so the next day, you get a sell here at the bottom. Again, take things in context. Are you going lower? Do you want to take sells? If you're going higher, I mean, it's up to you. Again, I like to trade trades in context. But, if you took this one, you sold it here, okay, you got to recognize you're wrong. Don't be getting out way up here. You get out really quick. So that one's wrong. And you get this nice buy signal here before it makes this nice big run up. Some sells, a little buy up there. This one, next day, didn't work. Ran into non-farm payrolls and get the sell signal. Sell, then a buy, and a buy that failed. Some buys. We're just going sideways. It's Friday afternoon already. Monday, this one didn't work. That one didn't work. This one, you got a nice little move up there. You got a buy, then a sell. Buy, then some sells, some sells. Some sells, some sells. Buy failed, sell, buy failed. Sideways, sideways, down, sideways, up. And you get this sell signal here. Where do you want to take a trade? Do you want to take a sell signal up here or a sell signal down there? It's up to you. It stays all over the place. Again, towards the end of the day, I'm not necessarily looking to be taking trades after 2 p.m. rather. I'm not necessarily looking to take some trades. This day, I wish I had the data. My day's a bit spotty in here. It's kind of jumpy. You did get this buy signal before my feed got cut off. 17th on the open. Again, I wouldn't be taking that early in the morning here. This one. The quick sell here went down. There, sideways a sell went down. Buy didn't work out. Then the sell did. Buy sell real quick. Followed up with a buy that just went straight up. Sell on the way down. Buy, sell again. Buy didn't work out. 2 o'clock around the close, you tend to get you can get some volume being traded there. This, I don't know, the 19th. Again, you're going sideways, back and forth, back and forth. You get the sell signal here, went down, went sideways, and you get the big sell signal right before it fell down. So you gotta ask yourself, right? Let's see if I can blow this up here a bit. I don't want to be sounding like a preacher. Again, it's about taking small losses. Now, where are you going to place your stop? You have your entry bar. You're placing your stop right behind your entry bar, high or low by a few ticks, okay? Because if it violates that, then, the reason for the trade is not there. And would you rather be taking, 5-tick losses here, to catch this move here? Or, I don't want to say catch this move, but, you did get a nice move here. What is that, about 70 full ticks? Euro currency trades in halves. So that's a nice move, but this is a nice move up here. Again, you got to ask yourself, you got this move up, this move down, then again, this nice big monster move down. Are you willing to take the small loss on this trade? on this trade. This one probably a little scratch. These again, it's right on the open. I probably wouldn't be looking to take those, but still, ask yourself, can you take small losses? Here, that big sell, then you got to buy here, right? It goes up. Then you got to sell, it comes off. Another buy, it goes up. It's about cutting your losses short. This one started to work out, then it went against you. Get out. Again, this one give you a sell, but then it just rallied right against you. Get out. This one, I'm not too interested because it's right on the open. This one failed. This one worked. This one worked. And again, that's 230. I'm not really interested. These ones right on the open, I'm not interested. Usually before 7, I'm not really interested in looking at the market. This one worked before it turned around. Give you a buy, and then it fell off. Again, it's sort of running into that 2 p.m. time there. This one, again, maybe you took this, didn't work out, but then it gave you this buy really quick. Doesn't, a little bit of something maybe there. Gets a little bit dodgy in here. If you expand it, sell, buy, then sell against, buy, then sell. So you catch this move, sell, but then you're screwed on this one. This one kind of went sideways, and then you get this little sell here. But again, it's getting close to the close. This one didn't. Again, that's a little too close to the openings before 7. I'm not really interested. 7, you get this one, you get a little move here. Here, you get a nice little move. Where's this market at? Okay. So anyway, you get this little move up here. Here you get a little bit of a move. Sell. This one didn't really work out. These don't really work out in the 27th. Failure right there. This one worked out a little bit. This one kind of sideways. This one didn't work out. This one a little bit. This one sideways. This one also sideways. This one a little bit before going against you. This is a little bit, it's already after 2 o'clock. I'm not interested. This one's a little too early. But again, you got to decide when you're going to be trading. There's a sell that turned around on you really quick. And then you get the buy that goes up before it curves on you. This is after 2 o'clock already. 2:30, you're pushing. This is February's non-farm payroll day. Again, right over, this is the number here. So, usually coming up before the number, it's extremely quiet. And again, that's the time that I'm not looking to trade at all. Later in the day, you get some movement in here, sell before it sells off. Another sell right ahead of it sells off. You got a little buy that failed on you. These little buys, sells in here, you're sort of scratching in here, maybe losing a couple ticks. You get a nice buy there, and nice sell here, nice sell there. 130, you get this buy that just sort of goes sideways on you. So that's the 1 minute chart. Okay, so this is the Euro currency 8 range chart. And same settings, 1 and 25, 1 and 25. Let's see if there's anything. This is on the 4th. And the first day there was nothing. On the 3rd. The 4th, what do you got? Okay, so you got the sell. Worked its way down. It's an 8 range reversal chart, so each bar is 9 ticks. So even if you get 1 bar, that's already 9 ticks. And get this nice buy here. The first one, you got a little something maybe. The second one, definitely something. This third one, it popped up against you before it went in your favor. Which kind of sucks. I don't like that, but sometimes that's what the market does. Here, it'll pop up a little bit before it goes against you. It's tough, it's trading is not easy. This one didn't work. This one, kind of back and forth on you. Here you sort of ran into some chop. This was the non-farm payroll number. That's the first Friday. And you can see you got this little move up here. This one went down, then moved up against you. Here's a nice move higher. Here's a nice move lower. But again, this is at 7:30 in here. This is 7:34. 7:35 is right here. 7:44. Usually this number I give it about 15 minutes to settle down. You know, so even if you waited, even if you missed that last one at 7, this one's around 743. So you could have got something here, something there. Now, is it better to look at a range chart or a minute chart? Well, again, it depends on your style of trading. Sometimes I think, you know, some of these indicators work better on range charts because, you know, when you're trading a range-based chart, it's based on price movement as opposed to time movement. You know, when you're looking at a time-based chart, a bar closes when it's time to close. It doesn't close because you're moving, you know, the market's moving. There's a nice little sell there. This is at 10:30. This one didn't really work out. Here, what do we got? Some failures here. Boom, boom, boom. Okay, so you got 3 in a row, but you know, you can have tight stops, right? It's okay. You can get it back on these next two or three trades here. You know, you get some of your losses back here and here. You know, here kind of goes sideways. Here you get some more. Here you get some more. Here you get some more. Here you get a lot. You know, don't be afraid to take losses. You know, it's not, you know, people don't like to take losses. I mean, it's okay. I understand the psychology behind it, but you know what? Depending on how you're trading, you're going to have losses. You know, like I said, nothing is certain. Here's a nice move up. Here's a nice move down. Here's a nice little move up before it goes sideways on you. Okay, here, this day, it's just all in your favor all day long. Here it shows it goes against you, and here you get a sell. A couple sells go sideways, couple buys go sideways, get stopped out. Here's a sell, but follows back with the buy. Then here you got the nice sell, and it goes lower. Nice move up. And a nice sideways. Here, sideways. They'll maybe book a couple losses there. Here's a nice little winner. This one is loser. Sideways, sideways, nothing. Somebody say nothing, but you know, sideways activity. Getting towards the end already. There's a sell. It kind of goes sideways on you. Here's the sell. 720 all day, all morning. And another sell. This one doesn't work out. This one starts to work out, then goes sideways. But you had 2 nice big winners earlier. You know, people, they want every single trade to be a winner. That's something you're not going to get. Every single trade is going to be a big winner. You know, here you take a loser, but then you know you stick it out and you get this nice big winner here. You know, this is 107.30 all the way up to 107. You know, this is 80 here, so that's 90. You know, it's a 50-point move. And then here's the late in the day, you get the little sell-off. All right, so that's the euro currency. Okay, so now moving on to the NQ, the mini NASDAQ. And what do you got here? Okay, I'm just going to blow through this. I don't want to make this videos too long, because if I start commentating on everything, it'll be a 3-hour video. But I just want you to see everything, you know, each day. I mean, like I said, some days are going to be better than others. Well, if you could buy it here, you got a nice move. Sorry, trying to keep quiet. Again, you run into, you know, this is pre-7 a.m. You're running into that. You know, keep that in mind when you're trading. You know, what time is it? 7. Really, the NASDAQ isn't going to pick up until cash open at 8:30 Chicago time. And this is 8:30 here. Failed. Sideways. This one, okay. Again, you see it like this, but this is, 6 in the morning, 6:30 in the morning, 6:37. Yeah, again, you see it there, like on these slow moving times, you tend to get this. I mean, be careful trading pre-cash open in the equities. That's just general advice. It's not brain surgery advice. Just, if you're trading mini NASDAQ, you should be trading it during the most liquid times. So it's a very thinner market. That's why you see all these mornings in there. This was a nice one here. Literally, you just get one one trade. Excuse me. One sign like that. Shit. Here's the market just sort of going sideways. Here, these are failures. I'm not going to sugarcoat it, but these are losses. You'll be getting stopped out, but you get stopped out pretty quick. If you stick around till 2:30, you get a chance to cover it back in here. Well, this is non-farm payroll here, 7:30. All right, so that's the 1 minute chart. We'll take a look at the 8 range real quick. All right, so mini Ezek 8 range chart. Again, I'll try and just blow through this, but I mean, you can see how it is here. You get into some areas with some congestion, but you get some areas with some nice moves. This one failed, but then comes right back down with a nice trade. Some failures there. That's a failure, but then it comes right back with a nice winner. Now again, are you willing to risk this little trade here to catch these trades? Some people say no. They want every trade to be like this. They want to sell here, buy here. But sometimes you're going to be buying it on the way down. And then what you want to limit your losses and wait for the times when you're going to get these moves like this. Here you take a little loss on this trade, but then you're patient. You sit through this next trade. It goes sideways on you, and then wham. Failure. Here's a failure. Well, that's right on the close. These are towards the close. Yeah, you break this day down. Yeah, you have a loss up here. Then you got a nice sell there. Some sells down here. Some sells here. A nice little sell here. Follow up with a nice buy here. Where are we here? Okay, what else we got going on here? This day is just kind of going sideways, but you are getting a little bit of something in here. in here. So even if the market does go sideways, maybe you could squeeze something out. So anyway, so that was an NQ. I think next is, I think, mini Dow. Let me check. Right, so this is a mini Dow 1 minute chart. Again, a contract like mini Dow, right? Thinner traded markets, especially if they're based on equities, mini Dow and Nasdaq, wait till the cash market opens. This is all pre-cash here, basically. You can see how it picks up the volatility. You get a nice sell here. This one fails. That one fails. This one a little close to the close. This is right ahead of the cash. Wait for the cash to open. No one's holding a gun to your head says you have to trade pre-market. But just sort of run through these things real quick. When you see it like this, someone is dumping their position, thinking the market's going lower for whatever reason for the near term. Doesn't always going to be, you sell here and it just keeps going lower all day. It's going to turn at some point. Trail your stop. People don't understand that they get short to catch a move like this, and they get out up here thinking, oh, hey, your indicator sucks. Well, where were you all this time down here? Why didn't you get out? I got somebody literally sent me a chart just like this, saying, oh, I didn't know where to get out, so I got it up here. Well, come on. Take a look at your trading and reassess it. Honestly, this is where it gets tough sometimes, where you have these sideways moving markets. Dow was, what, $5 a tick, I think. So it's not going to damage you too much. It's a nice move there. These are some failures there. Again, mini Dow is great because it doesn't give you moves like this. You can get in. You can get your small little losses in here and here, or wherever. But you get these moves like that sometimes very quick. If Trump says something, and if you're positioned on the right side, it's great. But have your stops. Here, nice one. These little areas like this, right ahead of the move. Excuse me. This is non-farm payrolls here. So anyway, so that's the 1 minute chart. I'll pull up the 8 range chart. Okay, so this is the mini Dow YM 8 range chart. Again, I'll just go through these days. Some days there wasn't very much on this 8 range chart. Still, nevertheless, show you, when it worked, when it didn't work. So you get an idea of, what sort of charts or time frames you can be trading. Of course, again, you don't have to stick to 8 range chart. You could use 10 range, you use 5 range, use 100 tick chart, 987 tick chart. It's up to you. It's up to you. It's don't have to copy exactly what I do. Everybody has a different way of trading, right? Pick up Market Wizards. Everyone's successful in the book Market Wizards, but there's 20 guys in there that each trade differently. No one is an exact copy of anybody else. Part of trading is developing your own style. People come to me, ask me, hey, can you teach me to trade? Yeah, I can teach you to trade, but eventually you're going to develop your own style. You're not going to be a carbon copy of me. So 8 range, mini Dow, it's average at best, maybe break even, maybe a small loss over that month. But, I want you to see it. I don't want you to just say, oh, he's only showing the charts where they're working better. But again, these were markets, what I consider thin traded markets. And they have the same settings, 1 and 25, 1 and 25. I'm not using the default settings. I gave you my settings there, right? These are my settings, okay? And it's not like I'm curve fitting it. These are the markets. These are the ranges. It's all the same. 1 in 25, 1 in 25, 1 in 25. Thin markets on, 1 minute charts. Now I'm going to get into the E-minis in the 5 years, settings of 1 in 25, because these are thicker markets. So the delta setting is going to be higher. If I use 25, it'll probably kick off a lot more. So let's take a look. Okay, so this is the E-mini 1 minute chart. Now, right off the bat, I can see there's a lot of signals. So I don't know if I want to stick with 1 in 25 or 1 in 250 rather. Maybe my trader might want to bust it out to 1 in 350, 500. It depends. You could play around with it a little bit more. 1 in 25 is going to be a lot of signals, so I know it's letting a lot of trades in. I can filter it out. By using a higher delta number of above 250, you'll be filtering out some of the weaker signals. But still, you're getting some decent signals. This day is a tough day here. Here you're getting some nice trades. Here's some nice trades. Here's some nice trades. Again, not every day is going to be picture perfect. On days like this, it looks like we're in a tight range. But actually, there's a couple points movements here and here and here. And this is where the real power comes in. If you're on a trend day, it just keeps you on the right side of the market all day long. Like this day is just straight, I'll say straight up, but it's moving at a nice 45-degree angle, and it's basically keeping you in. Giving you kicking off all these little buy signals here after after the cash open. You're talking a move from 62 up to almost 80. But every day is not like this. Yeah, those are the days you love as a trader, but unfortunately, a lot of days are just like crappy like this, or this even. What you like is those trend days. But unfortunately, you don't always get it, and you just get these small trades like this, up, up, up. But again, a lot of trading is being able to understand when you're wrong, and that's what this indicator can really help you. Let's see if I can blow this up a bit more here. So I know I have this bar here, right? This is the signal bar. If we're getting a tick or two below there, 3 ticks below, I know I'm wrong. So I know that this is going to stop. If I get stopped out down here. Okay, so this is the signal bar here, right? Low at 91 3/4. If I'm getting down to 91 1/4, I'm wrong. Okay, that's only 2 ticks, right? A 2 tick stop. You're getting in the next bar somewhere, anywhere between 92 1/4 and 92. And your stop is down here at 91 1/4, so 3 ticks. Okay. Are you willing to take 3 ticks of heat, and hope for something? Here's minus 3 ticks, minus 3 ticks. Well, this is non-farm payroll day, but having have some tight stops. Here, this one's you risk 3 ticks a couple times, but then you're getting a move from, I don't know what this is, 72 1/2, up to 5 1/2. So anyway, that's the 1 minute chart. Let's take a look now at the, what else do I got here? There's the 5 range. I think it's a 5 range. Not much on the 5 range actually, but still, put it up there for you guys to see. Actually, I don't know why. I thought I had a 3 range. I prefer a 3 range now on the E-minis more than the 5 range. Not that much here, you could see. Here's something that you could have got. Nothing up there. Here's some nice buys. It's not like there's a lot, but the ones that you're getting are pretty decent here. A couple points. I mean, I I hate to say it, but I know people that they're patient, and not everybody is patient. Sometimes it's hard for me to sit through days where nothing's happening. I've had to trade markets like that where you're just sitting there watching paint dry, nothing's happening, and you're looking for trades, but there's nothing doing. So a 5 range with this setting, you're not getting a lot, but the ones that you get are pretty decent. Decent in the sense of a few points. I mean, there's people that build their whole trading strategy just around getting 2 points a day out of the market. And the last one I'll look at is this 5-year. This is a 1 minute chart. 5 years is a nice chart to trade. Nice market to trade, because when it trends, it can move quite nicely. Come on. Okay, well, really, this one you should really blow up. But this is one you should test yourself. But again, you get some nice moves. Couple ticks, 3, 4, 5 ticks. Couple points even. But this is a market where it's very liquid, so it's very easy to get out. There's very good size in the market. I should open it up a bit more so it's a little bit easier to see. So here, this one failed, but you get something out of this, you get something out of that, you get something out of that. You get something out of this. Well, this is the close. This one, just kind of goes sideways on you. This one, you get something out of that. You got these buys that fail, then you get this nice sell that works out beautifully. This one fails on you. There's just no way to put it other than this one just spanked you. But you got to have a stop in, and you know that if you're getting stopped out, if it's trading up where this caret is, where the triangle is, that's where your stop is. The triangle prints at a certain distance, and I know that if we get to that distance, that's where I should be getting out. But then, okay, you get stopped out here, you get stopped out here. Look at this. This is a 1 minute chart, and over the next 2 minutes, it jumps from 30 up to 03. In the 5 years, that's like 15 ticks right there. Again, another example just like that. This one is in your favor all day. Again, here's a nice move. Here's a nice move. 250. You could go to some brokers, and you could get $250 margin. So even if you're just trading 2 or 3 lots, it's very cost effective. You can do it. I mean, people say, I don't have money to trade. Well, I don't know what to expect to come into the market. I mean, you don't need $20,000. I mean, it's nice to have $20,000 in your account. But some people want to get started trading in their paper trading, and I say get a small account. You could trade contracts like the 5 years with a few $100s. I mean, you should at least have a couple thousand in your account minimum. But if and don't think the margin's 250, you're going to trade 10 contracts if you got 2,500. No, it's 250. You trade 2 contracts maybe. You want to be around in case you suffer some trading losses. That's one of the problems is people get over margined, or not. They're highly leveraged rather, not over margined. But then you catch a couple trades like this. You could certainly build up your account. Everybody wants to come in and take whatever their account is, divide it by the margin, and that's how many contracts they're going to trade. No, don't do that. But yet some people insist on doing it. They think trading is the easiest way, so the more money they can put into it, the faster they can trade, the more money they'll make. It doesn't work that way. Okay, so like this example, perfect example of it just turns on you really quick over the next bar. Okay, so then it comes up, you get something here. This one kind of works, then it starts going against you. This one goes against you sideways. But then again, later, you get this nice trade. Again, are you willing to take a couple small losses to catch this? To catch this trade here? Catch this trade here? Again, people see this and think, oh, this is terrible. This is terrible. It's about managing your risk. That's what trading is about, is managing risk. I mean, for certain people, it's just all about risk management. They don't care what the market's doing. If they got a position on, they're good at managing their risk. They'll become profitable. They don't necessarily go in with a view. They just, for them, it's all about managing the risk. Managing the risk. I mean, I don't know how to describe their method of trading, but for them, it's just about, hey, I got a position on. If I manage it properly, sometimes I'll be right, sometimes I'll be wrong. It's all about managing the risk. So again, this one, you got to buy here. They came back with a sell that didn't work out. Okay, you're stopped out. You took your first trade, you took maybe a scratch or a tick loss. Second trade, you get stopped out. Well, then look, you're patient. Okay, you get another nice little buy here. Okay, maybe thinking, I give up on this trade. Then here, you get the signal again. And then look how it just jumps up on you. That's what I'm talking about with sweeping the market. Sometimes it's going to be like this in quiet markets. Somebody's moving some size. But what causes the market to move is absence of buyers or sellers. And what that means is if you have a big buyer come in and sweep the market, lift up all the sellers, there's no more sellers. And that's how you get this market to move like that. Okay, so this is, what day is this? This is the first. Okay, so this is already the end of the month, or this beginning of February already. So you can see, I put up a lot of different charts, a lot of different settings. Not a lot of different, a few settings rather, but on a lot of different charts. So you can see I'm not trying to like pick the most optimal. Some people will. I know some people have tested this over many different markets, a lot of different setting numbers, and are trading the best ones. I'm not necessarily, I don't say that you can't do that. There's nothing wrong with that. Because you want to find what you think works best for the market. If you don't have faith in what you're doing, then you'll fail, regardless of whatever it is you're doing, whether it's trading, whether it's making scrapbooks or, making wire jewelry. If you don't have faith in your abilities and what you're doing, you won't succeed. And, so what I'm showing you these different settings, the same settings over different markets, different types of charts, and how they are. Again, I go back, and first thing I say is I should make this the first slide. Don't use the default settings thinking that's all that's needed. No, these are preferred settings that I like to look at nowadays. And markets are always evolving. And again, who knows? In six months from now, maybe instead of 1 and 25, it'll be 5 and 30 or something. Again, these are not lines drawn in the sand that you have to use, and if you don't use them, you'll fail. No, not at all. But these are the numbers that I'm comfortable with, and I do adjust them. I said I don't have bonds on here. Bonds, I think I use 200. Okay, because the volume is slightly lesser than the 5 years and the E-mini. So I'm not going to use 250 on a market that's got slightly lesser volume. Right? It's going to be a smaller delta number. So instead of 1 and 250, I'll use 1 and 200. And if I'm fine with it, I'll run it over a week or so, back test it over a week, see how it looks. And if I'm fine with it, then that's what I'm going to use. So again, thanks for watching this video. And, any questions, shoot me an email. These indicators, I'm now giving away with the software, but, the only way you can get them now is buying the software of, the main order flows trader. You see me use them on bar charts because it's easier to show you. On a footprint chart, I'll get carried away with explanations of things. But I don't know. Some people say, you should just sell these indicators separately. We'll see. We'll see. I don't like people getting them and not reading. People don't necessarily want to take the time to read the instructions. I'll say, don't use the settings, and they'll use the settings, and they'll say it doesn't work. Then I'll ask, what settings are you using? That's why I created this video. It's to help people get comfortable with this and understand why these settings exist, what they mean, and how you can change them. It's not like, here it is, turn you loose, and that's it. I want you to succeed. Honestly, if I didn't care, if I didn't give a shit, it'd just be like, give me your money, and that's the end of it. If it doesn't work, doesn't work. Good luck on you. No, I feel bad if someone says, it's not working, can I have my money back? Well, I'll sit down with you, try to understand why it's not working for you, and how you're trading. Honestly, some guy came to me, bought it. First guy that bought it, he trades 15-minute charts. He says, it's not working for me. Okay, well, how do you use it? I use it on a 15-minute chart. Well, I know it's not going to be effective on a 15-minute chart. I would like to say yes, but I know. Order flow over the longer the duration tends to lose its effectiveness. Now, that's not to say you can't use order flow on a 15-minute chart, a 30-minute chart, but you're going to get very, very few trading signals. You will get some, but the frequency of them is going to be very infrequent. So again, it's not that you can't use it on long-term charts, but realize that it's not going to happen. You're not going to get the same results as you would on a shorter time frame chart. So if you're using the indicators and you're struggling, let me know what you're trading, what time frames you're looking at, and we'll go from there. Again, I'm here to help. I'm not here to just screw you over and take your money and you never hear from me again, although sometimes I think that's what some people think. But I want people to succeed, and if I didn't care, I wouldn't keep making these videos for you guys. So anyway, I'm sort of going off on my soapbox. But again, thanks for watching this, and I hope now you have a better understanding of how to use this indicator, what it's for, what it does, and how you can use it in your trading. So thank you, and see you on the inside.